As a buyer filling out a contract on a home that you're interested in purchasing, you're presented with a lot of questions, right? How much down? How long do you want for an option period? How much option money? What's the earnest? Closing date? Do you want a residential warranty? Who's going to pay for the title policy? That sort of thing. But the main questions we get off the bat, and they continue on oftentimes into the option period and past, is what's the difference between the money down, the earnest money, and the option money? So we're going to tell you now. Now the money down is the percent of the contract price that you are putting down with the lender, right? So if it's a $500,000 home, you're putting 20% down, it's $100,000. That's the amount of money that you and the lender have decided you will need to qualify for a loan. 20% is what people always think about. It can be less, it can be more. A vet may buy a house with 0% down at a great rate. The FHA loan may have 5%. So there are differences in the amount of money you need to put down. You can also pay a little bit extra per month and put 10% down. So there's strategy around it that will affect your monthly payment. But just so you know, that's the money, the percent down that you're paying to purchase the home and get the lender. Along with that, we have the earnest money. Now the earnest money can be seen as a goodwill deposit from the buyer to the seller, not directly, but to the seller, to the deal, showing their intention to close. We typically use 1% for a standard vanilla deal across the board, and that shows that I, as the buyer, have goodwill intention to purchase the home, and I'm going to even take that 1% of the contract price. If it was $500,000, that'd be $500 or $5,000, and give it to the title company, who's going to hold it in escrow until we get to the closing table. Once we get to the closing table, that $5,000 will be credited to the money due at closing. So it's not gone, it's not an addition, it's not extra, it's part of, but the title company is holding it. And so why are they holding it, right? If it's a goodwill gesture, so to speak, why hold it? Well, because under a lot of circumstances, after the option period, if a buyer were to terminate the contract, then the earnest money will be forfeited to the seller. So the risk is, if you decide a week before closing that you're not going to move homes because you just love the magnolia tree in the backyard of your current house, you're most likely going to forfeit that $5,000 to the seller. So what does it do when you're in a competitive situation? What does it signal to a seller? Well, if you're a buyer up against another buyer on a home and you have very similar offers at $500,000 with the same terms and all that good stuff, but they have 1%, and you have offered 2% earnest money, it shows twice the commitment to close the deal. So you effectively are saying, if I don't close after the option period, I am most likely going to forfeit this money to you, and I'm aware of that. Now there are exceptions to that, of course, and they're just much more limited and a larger conversation. But the earnest money shows goodwill intent to close on the deal. The more earnest money, the more intention, the more likely a seller is to accept the contract. The option money. This gets confused a lot of times with the earnest money. What's the difference between the earnest money and the option money? And then what's the option period, which is actually the right to terminate option period. And so the option money is an amount, usually around $200, sometimes $100, sometimes more, that the buyer pays the seller directly through the title company, but it actually gets to the seller right away. And they take it, they deposit it, they put it in their bank account, they go to dinner or whatever it is they want to do with it. That money is immediately gone. But it reserves and buys you the right to terminate the contract for any reason within the number of days negotiated as the option period. So if you negotiate 7 days, on the 6th day you wake up, you have a terrible hair day, and you decide your coffee stinks and you don't want to buy the house anymore, you can terminate, and it will only cost you the $200 or whatever you pay for the option period. After the 7 days, your earnest money's at risk. And there's much fewer exceptions to where you can terminate and get your earnest money back. The option period is a great way to show intention. Also, you can pay more for an option period. If you're up against somebody else that's submitted an offer, you can reduce your number of days of the option period. You know, if you can get 7 days, that's great because it gives you time to do all the inspections and all that good stuff and due diligence. But sometimes we submitted 5 days to show a more competitive offer. And yeah, we can get it done in 5 days. It's a hustle, but we'll get it done. So those are the differences between the down, the earnest, and the option money. There's more to it, of course. So if you have any questions, let me know. We're happy to answer them. Otherwise, let's go buy a home.